Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and what we'll be looking at today is technical analysis. And what specifically we look at under technical analysis, The specifics we will be looking at today include, we will start by looking at introduction, where I will be able to briefly explain the mechanics behind technical analysis. Then, after the introduction, we'll look at the technical analysis principles. What principles guide technical analysis? Moving on, we will move on and look at the logic behind technical analysis. Then, once we've looked at that, we will move ahead and look at the types of charts used in technical analysis. So what types of charts? Specifically, we will look at the following charts. We will start by looking at the point and figure chart. Point and figure chart there. Then we will look at the line chart there. We'll move ahead and look at the bar chart as well. And then we will finalize by looking at the Japanese candlesticks. Japanese candlesticks there. Then, once we've looked at these types of charts, we'll move ahead and look at the door theory. Then we will be able to conclude this first lecture under technical analysis. Now, we start off by looking at the introduction to technical analysis. Why is the introduction important? The introduction will form the sound basis as to why we are conducting or understanding technical analysis. Why are we learning technical analysis? The introduction will try and create that or arouse that interest for you, the learner. Now, what I can be able to explain under the introduction goes like so. Technical analysis tries to cover up where fundamental analysis left off. Fundamental analysis looks at the identification of the intrinsic value of a security or an asset. That is what we have been doing by looking at the free cash flow method. We've been looking at the free cash flow method. We have mentioned about the dividend discount model. We've also looked at the price multiples. We've looked at the residual income. Using those models tries to identify the intrinsic value, the true and fair value of a security or an asset. So that once we've identified the intrinsic value, we are able to compare it with the current market price there, such that if we have the current market price, I can put that initials like that, is greater than the intrinsic value, then you are saying that the security or the asset is overvalued. So, if the current market price is less than the intrinsic, it is the opposite of that. We are saying it is undervalued. Current market price is equals to the intrinsic, it is correctly valued, like that. That is what we have been doing by trying to look at those models that govern fundamental analysis. However, what fundamental analysis doesn't do is to try and explain the short-term price movements. What am I saying? These short-term price movements can be able to dictate whether there is going to be an uptrend or a downtrend like that, which we will be able to try and demystify under technical analysis. What technical analysis does, technical analysis tries to step in and tries to identify cyclical patterns in the price movements of securities or assets there. We're trying to identify trends or trend movements. That is what technical analysis does, and it tries to fit in, especially more so in this short-term period, trying to identify which securities to purchase during the short term there. Probably you might have experienced this when going into an investment bank or a stock brokerage firm. You would want to purchase securities for the short term. Fundamental analysis cannot be able to assist the analyst to make a decision and trying to identify the securities to purchase. That is where now technical analysis comes in. And we will be shortly looking at the technical analysis principles so that we can be able to reinforce our understanding of this topic. So we can be able to mention something right here. You can say technical analysis tries to identify or assist the analyst stroke investor in decision making as to which securities or assets they should purchase. They should purchase or sell. Now I'll explain the concept, the mechanics behind fundamental analysis and why now technical analysis tries to fit in the shoes of fundamental analysis. Fundamental analysis only tries to identify an assets stroke securities intrinsic value. And we had explained in the topic under return concept what the intrinsic value is. I'll just recap on what we looked at. The intrinsic value is the true and fair value of an asset. What an analyst believes the value of the security should be based on the four valuation models we had looked at. The four valuation models include, I'll reiterate again, the free cash flow, the dividend discount model, the price multiples, and the residual income. We are trying to identify the intrinsic value, what the analyst or the investor believes the value of the asset should be. And you compare that with what the Securities Exchange provides as far as the pricing of the security is concerned. So if the current market price, which that one that is issued by the Securities Exchange, is if it's greater than the intrinsic value, the one that you've computed, then we are saying that the security is over or undervalued. So we are saying that the fundamental analysis only tries to identify an asset or security's intrinsic value and compare that value with the current market price. The decisions made under this approach is long-term in nature. It's long-term in nature. So when trying to identify using fundamental analysis, you're trying to identify after some period of time, you expect the share price to either be undervalued or overvalued there. Technical analysis, on the other hand, tries to identify securities stroke assets that should be purchased or sold, in the short term. Because you're saying that short-term price movements tend to also impact or create longer-term price movements over a period of time there. So that is the brief introduction that I have under the introduction to technical analysis. We are saying that technical analysis may play a very critical part, especially when trying to identify small short-term movements or movements within the short term, which is say within 1 to 2 years there. So now moving on from the introduction right here, we will be able to move on and look at the technical analysis principles. What principles guide technical analysis? So we say principles of technical analysis. There. Now, having looked at and understood what the introduction or the mechanics behind fundamental analysis and technical analysis, the first principle states like so, that prices are determined. Number one, we can say prices are determined by forces of demand and supply. By forces of demand and supply. So we are saying that the demand for securities, if we have that demand curve here, so we have price and over here quantity like that, the forces of demand and supply. The demand curve is this one. I recall my economics, I remember the demand curve would go like that. And the supply curve would increase. You'd want to supply more to the market if the prices are increasing and like that. So that is the demand curve, demand versus supply curve there like that. And that is the equilibrium price. So we're saying that technical analysis is primarily driven by the forces of demand and supply. How many individuals who are demanding the security or the asset versus how many individuals are supplying the asset to the market. So there must be something to do with an equilibrium price, the price that is acceptable to both the buyers and the sellers. Number two, the second principle states as follows, that the demand and supply forces, the demand and supply forces, we're talking about that demand and supply curve there, are influenced by fundamental factors. Forces are influenced by fundamental and psychological factors. Fundamental and psychological factors. Psychological factors. There. We are saying the fundamental factors uses the information that is provided in the financial statements for companies. So the fundamental factors, I've already explained what fundamental analysis only tries to do, tries to identify an asset's intrinsic value there. And psychological factors are the belief that any investor has for themselves, that I believe, for example, that KCB within the short run will be able to increase by say 50% or 70%, like that. That is what you're saying is the individual factors that affect or that influence or support rather technical analysis. The third one, as follows, is that the fundamental factors can be psychological, can be quantified. We're talking about the fundamental factors can be quantified and the psychological factors cannot be quantified. So we say that the fundamental factors can be quantified, whereas the psychological factors cannot. So the fundamental factors, we're talking about trying to identify the intrinsic value, where we use numbers or figures. We can be able to at least identify that this, you're comparing the current market price versus the intrinsic value there. So at least that one can be quantified and like that, and a decision can be made using that. We are saying that psychological factors cannot be quantified because you cannot be able to identify individuals' perceptions about a particular stock, or neither can you also be able to quantify, say, the behavioral biases, because we are saying that behavioral biases can influence the market trends, either moving up or moving down, like so. Then we can also say that the combined effect of the fundamental factors and the technical factors is reflected in security prices. So I can come on this side over here, say that the combined effect you can say that number 4, the combined effect of fundamental factors and technical factors what can we say? We can say that it is reflected in the price movements of securities or assets like that. That is the 4th principle that guides technical analysis. We can look at the 5th one there, and we say that past price movements assist in the prediction of future price movements or trends there. So those are the 5 principles that guide technical analysis. The first one, prices are determined by forces of demand and supply. The demand and supply forces are influenced by both fundamental and psychological factors. Then I've said that the fundamental factors can be quantified, whereas the psychological factors cannot be quantified. The fourth one here is the combined effect of both fundamental factors and technical factors is reflected in the price movements of securities or assets there. So these technical factors here and fundamental factors work in unison, like that. Then you're saying that the past price movements assist in prediction of future price movements or trends. So you're saying the use of graphs and charts can be able to dictate or provide some bearing as to which direction the share price will move. Is it either going to be 1, 2, or 3 right there? So that is what you're saying. The analysis of past price movements like that can be able to dictate the future price movements in at least the short term. There. Now, having looked at the technical analysis principles that, there, let's look at the logic behind the technical analysis there. Logic behind technical analysis there. Now, the best way to describe the logic behind technical analysis is to use a graph. A graph of price against time is the best example that we can be able to use to try and understand that concept of technical analysis. So we are saying this is the price there, and this is time there. So we have the old equilibrium price there. We have it going down like that, and then we have like that. So we can be able to say this is the old equilibrium price, because you are plotting a price against time like that. Then this is the new equilibrium price there. This part right here is when the information is being released into the market. So when the information has been released to the market, investors decide or that they're not going to take up the new security, or the company's mechanics or the specifics dictate that it should be able to go down there, and less demand for that security will reduce the price of that security. So we say here is release of new information. This is just a hypothetical example that I'm explaining. It could be also the other way around. So we could have like that, a graph up to there, then it goes like that, and then we can be able to put it something like that. So we say this is the old equilibrium price is much lower, then we can be able to have the new equilibrium price being much higher as compared to that. But this is just a simple explanation that can be able to guide the logic behind technical analysis. So that is what we have there. Now, having looked at the logic behind technical analysis there, we can be able to look at the types of charts and used under technical analysis. So we move on to look at the types of charts and used in technical analysis there. I hope this has actually provided some guidance. The logic behind technical analysis is simple. You just need to plot a graph of price against time, and you understand the impact of release of new information. Once information has been released to the market, then that creates or arouses some interest or disinterest. Meaning that in this case over here is a disinterest. This first graph that I do over here. So this is the old equilibrium price. The price was much higher over here. Then the release of new information, possibly negative information, reduced the amount of demand for that security or asset, and hence now the new equilibrium price is much lower than the old equilibrium price right there. However, in this dotted line which I've drawn moving up like that, this part over here indicates the old equilibrium price, which was much lower. The release of new information within that part over here aroused interest or aroused some form of some form of demand for that security, so that you can be able to see over here that the new equilibrium price is much higher than this dotted line which began over here. So the logic behind technical analysis is just driven by forces of demand and supply. That is what I can be able to explain under the logic behind technical analysis. Now, moving on, let's look at the types of charts used in technical analysis right there. So I can come on this side here. Look at the types of charts. So types of charts used in technical analysis. Now the first type of chart that we are going to look at is point and figure chart, or rather let me start first of all by looking at the line chart. Yes, let me just start right here. I'll be able to explain all of them anyway. So the line chart. Now a line chart is a simple plot of price against time. Now this is how I can be able to demonstrate a line chart. Now we are saying here we have price, like that, price against time, like that. And as time goes by, the forces of demand and supply changes the price of the security or the asset. So you can begin there, it moves there like that, it moves down like that, moves as it moves up like that. So we are saying this is a line chart there, indicating this as time is moving at this part over here. You can see is different from this part, it's different from here, and so on and so forth, like that. That is what you're saying is a line chart. You just plot the prices against the time, or as time moves on, you can be able to plot the security and price pattern. So this is a line chart there. Now we look at what a bar chart is. A bar chart right there. So a bar chart is a chart that is drawn like so. You can draw it right here. That. Then we can say that this is just the plot of price still against time, like that. But now in this instance, what will happen is that we are going to plot now the starting price, the opening price, and the closing prices like that. Here is the midpoint there. Then as we move on like that, we plot like that, a bar chart like that, and so on and so forth like that. So you can be able to clearly see that this is an uptrend, or the trend is moving in that direction. As well in the line chart, you can also see this an uptrend moving in that direction. However, if it's moving down like this, say from over here, we can be able to decide maybe it goes down like that and moves down like that, moves down like that, and this is now a downtrend that is moving like that. That is what we can say is a bar chart. So I can indicate over here, just over here, number 2, bar chart. Now, having looked at those two, let's look at now the point and figure chart. The point and figure chart right there. Under the point and figure chart, a plot of only prices is provided, but now in a very different and unique way. The plot against price alone is the one that is used. So we are saying this is what we have like that, and then we don't have an x-axis there. We only have the y-axis here. So here you have price prices of securities like that. And you're saying if you have a rising trend, you can be able to indicate that is for a specific time period, say within 1 hour, and the prices have actually increased up to that level there. So this is, say, for example, 200, 201, 202, 205, 207, 210, and so on and so forth as we increase like that. However, after this 1 hour, you can be able to find that now the prices have begun to reduce. So you find that this is what happens. We can indicate the reduction using circles like that. And if there is an increase in prices as well, we can be able to continue and put X's like that. And if it's a downtrend, then we can be able to indicate like so, and so on and so forth like that. That is what you're saying is a point and figure chart. We can also plot a point and figure chart using the actual prices. So we are saying that over here, if you can be able to have, say, a parallel diagram, right, just besides this point and figure chart right here, and indicate now the prices over here. So we indicate, instead of having the x-axis indicating the prices like that, we put it now on the graph itself. So we have 200, 201, 202, 205, 201, 210, 210, and so on and so forth like that. Then you find over here now a reduction, 205, 202, 201, 200, 199, 198, 97, and so forth like that. Then we have now 201, 202, 205, 207, 209, and so on and so forth like that. So you can see there's a slight difference between this point and figure chart and this one, but you can be able to induce some kind of or infer some kind of decision over here. You can see this is the congestion area or the concentration area right above this part over here. That's what you're saying is the congestion area like that. Now, having looked at these three, we can say this is the third one over here, point and figure chart there. Then finally, we can look at the Japanese candlesticks over here. Why these are important is because technical analysts believe in the use of graphs and charts to try and identify price trends that can be able to assist them in making decisions as to which securities to purchase or assets to purchase. Number 4, we're talking about Japanese candlesticks. Japanese candlesticks. Now, what you need to understand under Japanese candlesticks is, first of all, the look of the candlestick itself. A candle looks somewhat like that. Here, before I put this wick over here, I can be able to have that body indicating over here opening, price, closing, price. We can have like that, or we can be able to have another Japanese candlestick like this, where we have the closing price and opening price like that. So you can see this is the opposite of this one. Here you have the higher closing price, and here you have a lower opening price like that. Now, putting that understanding onto a graph, this is what we come up with. We have a graph like so. And put it somewhat like that. Then we can be able to identify now, we can draw now that candlestick over here with that and that. What I didn't explain on these graphs is that here you can be able to have the wick over here. You have the highest price, highest price, and here you have the lowest price like that. So you'll have candlesticks like this moving in this direction that provide some guidance to the analyst or the investor that this is a bullish trend. A bullish trend means that it is moving in an upward direction like that, with even highest price happening, higher opening prices or even higher closing prices. Remember, if you're looking at it from this perspective over here, you'll have the opening price being over here, the closing price being much lower. But now, this scenario is usually very typical when you're having a bullish trend, where you have a closing price moving higher and higher and higher. So here you have the closing price, closing price, closing price, closing price, and so on and so forth like that. But now when there's a bearish trend over here is where you'll be able to see that the closing price will tend to be much lower than the opening prices like that. So that should be understood from the Japanese candlesticks perspective. So here we have the price, here we have time moving in that direction. These Japanese candlesticks are the most commonly used by technicians because they indicate the closing prices and the opening prices in a probably maybe systematic fashion compared to the other charts that we've actually looked at there. Now, having looked at the four types of technical charts, technical analysis charts right here, now we move on to look at the Dow theory. Dow theory. Charles H. Dow was an editor of the Wall Street Journal between 1900 and 1902. Being an editor, he was the founder of the Dow Jones Industrial Average and the Dow Jones Transportation Average there. Those are indicators that assist technicians or technical analysts to identify price movements. What we need to understand under the Dow theory is that the historical price movements like so, these historical price movements like that can be able to provide an indication for the price trend that is going to occur in the future there. Now we look at the principles backing the Dow theory. Principles of the Dow theory. Now, Charles Dow said that the price movements of securities move in three directions or three movements: the primary trends, the secondary trends, and the minor movements. Take this example. If you have, say, a bucket full of water like that, this bucket and it's full completely, you hit it on the side like that, you will be able to see the ripples moving towards the center like that. Those are representative of the minor movements. You hit it slowly, or if you hit maybe say a cooking pot like that which is full of water, you'll be able to see ripples moving like that. That represents the minor movements. That. Now, the primary movements and the secondary movements, the primary movements are synonymous to what we can be able to say tides, and the secondary movements are similar to waves. Waves are smaller than tides, and the minor movements are the smallest like that. Putting it all together, before I actually come to the principles of the Dow theory, what I can say is this: if you have a price movement moving in that direction like that, this would be able to now indicate that's the actual price movement. So you will find the price movements, or you're saying that you have the primary movements indicative of that movements like that. I should have probably used maybe a fainter kind of marker like that. So this is the security price is moving like that direction. So we can be able to have like that the price movements moving in that direction. That is what we're saying is the secondary, the primary movements there. The secondary movements are usually smaller, like that guide the direction movement of the price, like that. The minor movements are indicative of very small movements of prices in that direction, similar direction of those two other trends, like that. That is what we're saying is the Dow theory. The Dow theory has got three postulates, and the postulates or the principles are as follows. Number one, we can say like this, that all information that is guiding the Dow theory there is reflected in the averages of market prices. So all information is reflected in the averages of prices, of market prices. And those averages, what can we say? We can say that those averages reflect market movements. Those averages reflect market movements. That is the first postulate, like that. I shouldn't have put it in form of bullet, I should have put it like that. That is the first principle. The second principle can come on this side right over here. You can say that the averages exhibit three movements. Averages exhibit, number two, the averages exhibit three trends, primary trend, which is representative of tides, secondary trend, this is trend, it represents say waves, and the minor trend, which represent ripples. That. Number three, all the three trends move simultaneously. All the three trends move simultaneously. So those are the principles that guide the Dow theory. This comes to the end of our first lecture of technical analysis. We hope that you can be able to join us in our next lecture, where we will continue with the same topic. Thank you. God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.